Good morning and welcome to the annual general meeting of the Leicestershire County Council Pension Fund. You all should have access to the papers for the meeting, which are published on the Pension Fund and County Council website. Just a reminder, the meeting is being broadcast live via YouTube and will also be available for viewing following the meeting. We've had apologies from Mr. Grimley, Mrs. Page, Mr. Shepherd, Councillor Whittle and Councillor Kelvin. The first item on the minute is item 1 on the is I move the minutes of the meeting held on the 11th of December 2023 be approved. Is that approved? Yeah. Fine. Item 2, question time. I've received a number of questions from Mr. Anthony Simmons. The questions and my responses have been circulated prior to the start of the meeting and will be taken as read. These have also been published on the Council's website for public information. I remind those present that there is to be no discussion on these questions. I understand that Mr. Simmons is present and so has the... Hello, Mr. Simmons. I understand. Have you got the microphone on? Can you just turn it on? Okay. So just leave your microphone off for the moment. Okay. So Mr. Simmons is present and so has the opportunity to ask one supplementary question for each question submitted for the purpose of clarifying the response only. There should not there should not be an introduction of new materials. I've now invite Mr. Simmons to ask any questions he may have, and if you could refer to the question number when asking, that would be helpful. So over to you, Mr. Simmons.
Right. My supplementary question relates most directly to question 5 that I raised. It arises out of the replies to earlier questions as well. And I believe it was raised at the previous committee meeting, yet I did not find a conclusion to what I'm about to ask. So when replying to the government's consultation, will the Director of Corporate Resources and the Chairman be asking the government to define local as the geographical area covered by a fund, e.g. for us it would be Leicester, Leicestershire and Rutland, rather than an area covered by a pool or the UK as a whole?
Thank you for that question. It's obviously something that, yes, we will. We will definitely be asking the government because it's going to have quite a major impact on the pension fund and where we can invest. And whether it's UK-wide or locally, yeah, that is definitely one of the things we will be asking. And when we get a response, we'll come back to you. But yeah, very valid, very good question, because that's what we're all asking. That's what we're all wondering. But as soon as we have an answer, we'll let you know directly. Okay. We have not received any questions from elected members. There are no urgent items under item 4. Declarations of interest. Does anyone have any declaration of interest of items on the agenda today? It appears not. That's fine. So on to the Pension Fund Annual Report and Accounts 22-23. The first substantive item on today's agenda. The Pension Fund Annual Report and Accounts is on pages 11 to 120 of the agenda. Declan Keegan, Director Corporate Resources, Ian Howe, Pension Manager, and Bulesh Karcher, Senior Financial Analyst, will talk through the presentation on the annual report and accounts, and Kat Chewy will update us on the fund's responsible investment. This will be followed by a question and answer session. So over to you, Declan.
So just an outline agenda of what we're going to sort of talk through is just up on the screen at the moment. So the first 2 points are just really background to the fund and the role locally that we have in administering it. The third point, as the Chair mentioned, Ian's going to pick up the sort of the performance of the administration functions of the fund and give a bit of an insight into some of the key changes that are going to be impacting the scheme over the sort of foreseeable future. Then Bulesh will pick up on the kind of the investment side of things. You know, how is the fund invested and kind of how has it performed kind of more recently, but also alongside some of the questions that were picked up obviously about sort of government's plans to speed up pooling and the impact that's expected to have. And then finally, Kat's just going to take us through responsible investment, which is really just explaining the steps that the fund takes to make sure that they're good stewards of the assets that we do hold. So turning to the first of the slides in terms of the sort of what is LGPS, it's up on the screen. It's kind of it's a national scheme, although it's run sort of locally. Most of the rules are set nationally. There's a few bits and pieces we can tinker, but it is around the edges. It is very much, if you work for a council sort of or a school kind of in Leicestershire, it's going to be the same sort of LGPS sort of scheme as if you were in Nottingham or kind of Northumberland or Surrey. And it's what's known as a defined benefit pension scheme. And most pension schemes did used to be defined benefits. You know exactly what you're going to get out for the money you put in, whereas there's been a bit more of a move to kind of defined contribution, which is more you put your money in and it's down to you to invest and kind of, you'll find out how much you've got for retirement when you retire. Whereas subject to things like inflation or potentially kind of your final pay, you pretty much know the benefits you're going to get. And with LGPS, that's enshrined in law for those benefits. The scheme does change, although it's just that it's enshrined in law. Governments obviously can change those laws. So at the moment, most people have a mixture of kind of benefits that are based on the final salary that they earn, or more recently, if you've sort of joined the scheme more recently, based on the sort of your average earnings over your kind of career, and that's just sort of set on an annual basis. So the scheme does change a bit, and it's kind of, you can see how the sort of changes like that help with sort of the predictability of the sort of the scheme, but obviously the sort of the background to a lot of these changes is kind of financial. The scheme's a pretty big scheme. It's kind of, Billish will touch on about 6 billion of assets, but we've also got 183 different employers. So it's not just a council thing that, it does touch into sort of schools and academies, universities, even some private sector employers where they have taken functions from one of the sort of the core employers of the scheme is get covered by that as well. And as I said, it's a national scheme. It's overseen by sort of the Ministry of Housing, Community and Local Government, which until recently were known as Department of Levelling Up, if you were wondering what's happened there. But also it's a heavily regulated industry, which you do expect with the sheer amount of money involved. So we do have to look at what's happening with the pension regulators' guidance, but also people like the Financial sort of Conduct Authority do regulate the advice that we get given. And the scheme, and sort of Ian touched on this a little bit more, the two bodies, we've got the pension committee who do a lot of the sort of the main delegations to sort of make decisions for the scheme, and the board is there in making sure really the governance is sort of followed and that it's up to scratch. So you've kind of got the balancing act of those two bodies coming together. So if I pass over to Ian, he's going to sort of pick up the administration side of the fund.
Thank you, Declan. Good afternoon, everybody. So touching on the governance angle, there's two elements to the governance. There's the pension committee and there's the pension board. The committee is chaired by Councillor Barclay, who's today's chair. That's the delegated authority and takes overall responsibility for the fund. The committee is made up of 10 employer representatives, elected members and university reps. There are 3 non-voting scheme member representatives, and the principal aim of the committee is to consider pension matters with a view to safeguarding the interests for all scheme members. And as administrators, we take reports to committee. Then there's the local pension board chaired by Councillor Page. That's made up of 3 employer representatives, elected members, 3 scheme member representatives, and their role, the board's role, is to assist in the administration really of the admin authority to ensure the effective and efficient governance. So we also report to the board, and actually as an administrator we report to the board more regularly than committee. So what are our main purposes? Well, I'm the pensions manager, so the administration of the fund is principally broken into a number of areas, calculating and paying all types of pension benefits. Predominantly that's retirements and death benefits. We also deal with employers joining and leaving the scheme. As Declan said earlier, we have 183 employers in the scheme currently with active scheme members, but that number does fluctuate, and we have a group of colleagues who deal with the employers joining and leaving. We also deal with regulation changes. I'll touch on that slightly later as we go through this. We deal with year end, and the annual benefit statements for our scheme members that come from the year end. The deadline for annual benefit statements is the 31st of August each year, and we have to get the statements out by that date. We also deal with the fund valuation. That's every 3 years, and just sat behind me is the fund actuary Hymans, and they'll be talking later more about the fund valuation. And in terms of the governance, as I've already mentioned, we report to both the board and the committee as part of the fund's annual report. Talking about the administration stats, this gives you the numbers of how the stats have changed over the last since 2022 to 24. So as at the 31st of March 24, we now have over 40,000 active contributors, and you can see showing on the graph that that number just continues to rise regularly year on year. Preserve members, they're members who were in the scheme who are no longer active contributors but aren't yet old enough to claim pension benefits. So those pensions are preserved. Now we have over 32,000 preserve members, and pensioners nearly 34,000 as of March 24. And again, that number continues to rise. So as at the 31st of March, we had exactly 107,000 scheme members. So they can see that the scheme size continues to grow. In terms of the admin statistics, these are the stats for 23-24. I won't go through every line because you can see the numbers on there, but I think the two that I would just pick out: retirements, over 3,000 retirements in the year, and the bottom number there, 9,552 new starters. So over 9,500 active members still joining as new members. So you can see that the scheme continues to have high numbers and all the numbers in between as well. In terms of the key performance indicators, we split these into two groups. So the three on the left-hand side are the business processes, and the ones on the right-hand side are the customer experience. So if we start by looking at the ones on the left, we have three. So the retirement benefits notified to members within 10 working days. We achieved 88% throughout the year, which was slightly below target. And pension payments to members within 10 working days, 94%, which was just 1% below target. And death benefits to dependents within 10 working days, we managed to achieve 83%, which was 7% below target. So whilst they are slightly below target, looking at the numbers of the scheme members and the complexity of the scheme regulations that changed during that financial year due to McLeod, they are pretty impressive numbers. The figures on the right-hand side of the customer experience, and I won't go through those line by line, but you can see that all of those were higher, or one just close to target. So a very sort of strong year throughout 23-24, and credit to that goes to colleagues in the pension section. Many of them are here today, so thank you to those colleagues who are dealing with that work. Looking ahead, I've touched on McLeod. I've already mentioned McLeod briefly. I'll explain a little bit more about McLeod dashboards and the expected national pension changes. Thanks, Kat. So McLeod. The McLeod changes came around in December 2018 following a Court of Appeal, which basically was brought about by somebody who was questioning the age discrimination rules around the change to career average. And that decision was upheld, and we have to change the calculation of pension benefits to effectively compare the benefits under the final salary compared to the benefits under career average, and we pay the higher. This was implemented in October 23, so that's why some of those stats earlier on that I showed you started to fall away towards the end of the year. It continues to be a challenge. It's been a challenge since the beginning, but it continues to be a challenge. Benefits that are being calculated now for people retiring actively are run, and McLeod is taken into account, but we still have the work to do to go retrospectively back So people between April 2014 and March 22, we've got to go back and review those cases for anybody in scope and compare the two and recalculate the benefits. And if a benefit is actually higher under the McLeod ruling, we then pay the arrears and put the new value into payment. So that'll be an exercise as we roll forward into the 2025 calendar. Just want to briefly talk about dashboards. Dashboards is a national move to improve the pensions experience. So what's going to happen is people will have a single sign-on where they will be able to sign on to the national dashboard, and they'll be able to search for all their pensions in one single place. And we obviously, as a pension scheme, will be linking into the dashboards. So if a scheme member was to go onto the dashboard, they will put some personal information in, some secure information. That would do a trace, and if there's a match with our fund, that data would then be pulled across and the member would then be able to see the information that's held for them in our scheme. And that would be the same for all pension schemes moving ahead throughout the UK. So it's a massive national exercise. Leicestershire, we've started to connect already. We did some testing actually only recently in the last month or so with a connection date of the 31st of October 25. So we're ahead of the game and we're moving positively. All pension schemes in scope must be connected to the dashboard by the 31st of October 26, which is the go live. So we're ahead of the game, but there's going to be a big communications both at national level and within our fund when we get to that position, so scheme members are aware of the dashboards. Final thing I just wanted to mention are looking ahead, some national pension changes that are expected in the coming years. The first one was announced in 2014, so it's going back now, but it's the minimum retirement age is increasing from age 55 to 57 in April 28, and that date is to coincide with the rise of the state pension age to 67. We expect there'll be some form of protection for members who are impacted. So if you imagine somebody who is, for example, age 56 in March 2028, they could then claim the benefits. But then a month later into April 2028, they're then too young to claim the benefits because they're not age 57. So we expect some protection for people like that. Ill health retirements will remain protected as they are now. So people under 55 or 57 from 28 will still be protected. And the other one is the announcement made in the recent budget in November about the death grants being in scope for inheritance tax from April 2027. So just for an awareness piece, really, that previously those benefits were outside of the estate for tax benefits, they will now be included, and pensions will have an administrative role there in working out whether an element of that death grant is due for tax, and if it is, if it's deemed taxable, pensions will pay the tax to HMRC and then pay the remaining amount across to the estate. Thank you.
Hi, I'll take you through the pension investment side of our portfolio. So our first slide here is our current investment goals. And we've got a number of bullets there, but if I refer to the graph at the bottom first, it shows the size of the fund. We're at about 6.5 billion there at the 31st of March 2024, and that's a full 50% bigger than it would have been at March 2020. Now, on its own, it doesn't make much sense, but we've got our colleagues Hymans Robertson behind us who will talk about the size of the fund versus the liabilities later, and we'll be able to see how the funding level has progressed over time as well. We do take a really long-term view of investment returns. We don't make short-term or tactical decisions as such. We have a really big, strong commitment to responsible investment, and we do have a comprehensive net zero strategy, which was approved in March 2023 after some engagement and consultation the previous year. We look after our strategy for the investments, i.e. where we do invest once a year. We do a balancing exercise, and Hymans Robertson, who are also our investment advisor, advise on that. We have lots of diversification within the fund, lots of access to every different asset class you could probably think of, and we'll go through some of those on the following slides. So this slide here, I'll talk to the pie chart on the left first. If we kind of go around in a clockwise nature, you'll notice we've got listed equity as the biggest component of the fund, and this is the snapshot as at the 31st of March when the fund was valued at 6.3. So 42% of the fund was in listed equity. There's the kind of things that you'd see, you know, on the stock market that you can buy and sell every day. A smaller proportion is private equity, things that you can't buy on the listed markets, things that haven't quite come to the market yet. And then we've got a little slither there, about 5% at the bottom, classed as targeted return funds. So these are funds that there's two managers in particular that aim to make a return regardless of market conditions, up or down. Taken together, those three classes we class as the growth type. So these are the arguably higher risk, higher volatility investments for the fund, and they're about half of the fund. The next 5 or 6 portions on that pie chart. So these are infrastructure, private credit, property, credit in general. We class as income investments. They make up a growing proportion of the fund, and it's best described there on the bar chart on the right there, where you can see that middle bar for each of the years. So you can see there's 4 groups there. The first group being 21, 22, and then the last bar is our target. Now you can see that blue bar in the middle of that growing over time. So that's us trying to grow that middle part. So that's infrastructure, private credit, property, and credit. So these are slightly lower risk and slightly less volatility. And as the fund has matured and become better funded, we've taken a bit of risk away and kind of shifted slowly towards that middle bucket. The final investments within our fund are inflation-linked bonds and investment-grade bonds, and some cash and a currency hedge. Now, these are classed as our protection assets. They're not a big portion. About 7.5% is the target for the fund within these asset classes. Thank you, Kat. So this slide here talks about our investment returns for the fund. We've got that top bar chart there, which is discrete annual performance. The first bar there being 1920, slightly negative returns. And we've got 2 bars for each year. We've got the actual per annum return and the benchmark, i.e. what we expected to get. That first bar, you'll probably remember the last month of that year would have been the drawdown when COVID struck and everything closed down effectively. So a lot of the negative performance came in that final month for that year. The following years have been largely up and down, you know, a really good year in 2020, and then kind of average years in between, if you like. But the graph at the bottom is the one that you want to kind of really look at, and it shows our longer term cumulative performance over 3 years and 5 years. And what I'll say there is that the actual performance and what we expected to get are pretty much where we thought we'd end up. So 3-year performance, about 6.3% a year. We expected 6.3. Over 5 years, 7% a year. We expected 6.8. So, you know, neither here nor there in terms of difference to what we expected. This slide here talks about LGPS Central. Now, LGPS Central is the pooling company that the Leicestershire County Council Pension Fund, along with 7 other partners, jointly owns. We try to use LGPS Central for all our investments wherever it's possible, and we'll talk about the investments that we have with LGPS Central over the next couple of slides. So it's one of the 8 pooling companies across the country. It's been in operation for about 7 years now. The total value of the pension assets from the 8 partners total over 60 billion. So our 6.5 plus the other 7, about 60 billion. And it's one of the larger pools in the country, alongside one pool called Northern LGPS, Access, and Borders to Coast, all of which are about similar size. As at the 31st of March 2024, 32% of the 8 partners funds were pooled within LGPS Central, and that includes the commitments we've already made, Add that together, there's another 24%. So our pool is quite big. So more than half of our funds from our 8 partners should be pooled over time fairly quickly. They have a combination of internally managed and externally managed products. They cover passive index funds, active equity funds, private markets, and in total, there's 27 products in total that they've launched. They are a single manager for us, so it helps us in simplifying our fund. So we have fewer mandates to look after. So we can go to LGPS Central and they look after a whole host of investments for us. For us in particular, they do look after listed equity, that's active and passive, private markets, including property and infrastructure, all the way through to credit funds. They also provide us really good access to ESG specialisms, including responsible investing and climate risk reporting, which we bring to the committee once a year, normally in November. So this slide here looks at our investments with LGPS Central. I touched on it on the last slide. So we've got a list of bullet points here. I won't read them all out, but it gives you a flavour of the kind of things that we've invested in with Central. So the thing to take away here is the pie chart on the right, and it shows our investments as at the 31st of March. So that you can see we've got 40% within Central funds already. We've got a carved out section at the bottom of that pie chart, which is the 17% that we have with Legal and General Investment Managers, which was a collaboratively procured fund. These are really low cost passive funds, which we are in the progress of moving over to Central. But given that they were so cheap to buy in the first place, there's very little cost savings in moving them across to Central. But taken together, that's nearly 60% of the fund that we class as pooled. The remaining 36% there you can see are what we've called locally managed, but effectively these are funds with external managers. Moving on to uncalled commitments. So when we make investments to private markets, so things like infrastructure funds and private credit, for example, we commit to an amount to that manager and they call it down over time whenever they need that money to be invested into whatever they're investing. Now, the fund has a really high amount at the minute of uncalled commitments. As we transition towards that middle block I talked about earlier within that income asset class, and you can see that 940 million of uncalled commitments as at the time of writing. They're split across private equity, infrastructure funds, private equity and property. Now, the thing to take away from this slide is the majority of that 940 is with Central products. So about 80% of that 940 is earmarked towards Central products. So the amount that we pool over time is growing. Moving on to the Fit for the Future consultation. So this is the government's consultation that was launched recently. And what I wanted to bring out here was the 3 main elements that exist within there. You can pretty much just make out the 3 different colours. So I'll go over each in turn very briefly. So they wanted to seek our views on 3 main proposals. And the first was reforming the LGPS asset pools. And so that is the administering authorities to delegate implementation of our strategy to the pool. So the administering authority would work out the high level requirements for the fund, and then the pool would decide which funds to invest into. So that's one of the principal parts that they're looking into changing. They also want administering authorities to take the majority of their advice from the pool and to transfer the assets to the pool by April 2026. So this was the amount that I called locally managed earlier. The second part is boosting LGPS investment in the localities and in UK. So that's investing more within the UK. We need to get some kind of clarification on what UK means. Does it mean within your pool area? Does it mean the UK in general, or does it mean really within your county? We'll be asking government for some clarification around that. And the last part there is strengthening governance and administering authorities and the LGPS pool. So this is a lot of work that's already happened. So the SAB's Good Governance Review picked up a lot of this, and it's probably time to start implementing these. So a paper was presented to the committee last month. Feedback was received, and a fuller response will be submitted by the deadline, which is the 16th of Jan 25. This last slide here talks about how we plan to look at taking across the whole fund, that's the full 6.5 billion towards Central. So what I've done here is I've looked at the part that's already pulled. So that first bar there on the left is the 2.6 billion, which represents the 40% already with LGPS Central. And then you've got two relatively easy blocks. You've got that 1.1 billion and that 93 million, which are in the train almost. They're almost ready to go to Central. And taken together, that will take us to the nearly 60% I mentioned earlier. And then we've got a number of smaller bars here, which become progressively harder to move to Central. You've got the next two bars there, which are the 327 million and the 296. The first one is our liquid targeted return, which could be sold and reinvested. The next one after that is our liquid funds within index-linked bonds and corporate bonds. Again, could be sold and reinvested with Central, or we could just pick them up, move them across. The last two, they're the 591 million and the 940 are the more illiquid type assets. So quite difficult to sell. In some cases, you can't sell them. There's not a liquid market to do that. And the answers might be around picking them up and let Central manage them for us, let them run them down and then reinvest them in other things. So our plan is largely progressing. Most administering authorities will have a similar makeup, but they'll have really illiquid stuff, which will be quite hard to sell. And how we work through that and get to that deadline of April 2026 to pool everything will be quite critical in the next year as we work this through with the government and other administering authorities and take views of all. I think that's my last one, Kat.
Thanks. So yeah, I'll go next for the responsible investment and climate type slides. So I think just to set out the background of how we consider responsible investment, this is something that as a long-term asset owner, we believe that responsible investment can enhance long-term investment performance. So this is a belief that has been integrated into the investment strategy statement and is considered through our kind of continued commitment to our annual responsible investment plan. And this is kind of key in two main ways. So first, we consider material ESG factors on all of the investment decisions that are made by committee, and that includes climate change. Second, we act as a responsible investor, so we vote our shares and vote on company annual general meetings, and we also engage with our investment companies, investment managers and the underlying companies, and this is through LGPS Central and also other partners that we have. So I guess taking climate change as an example, so we recognise that climate change poses risks that are both physical, so issues such as extreme weather, disruption of supply chains, and then also transition risks, so changes to policy and regulation, such as introduction of carbon pricing and changing consumer demands. These same risks present opportunities, so we also see investment opportunities, which I'll come on to over the next few slides. This kind of general approach is quite important just because of how diversified the fund is. So the fund, as Bill just mentioned, it essentially represents the slice of the global economy. So the fund has responsibility for asset allocation, manager selection, and manager monitoring, but ultimately the day-to-day investment management decisions regarding what to buy or sell are made by the specialist investment managers. I'll go on to the next slide. So just to kind of show some of the progress so far, especially in relation to climate change, it's just kind of a little map, I guess, to show where we've gone. So even back before the fund had a climate strategy, the fund had already started investing in forestry. We then became a member of the Local Authority Pension Fund Forum, and this is a group that have around 350 billion in assets, and they pretty much span the whole of LGPS funds. And they do a lot to promote the highest standards of corporate governance and corporate responsibility across environmental, social, and governance factors. This was followed by development of a responsible investment plan that the committee considers at each January meeting and approves. And we also in 2019 had our first baseline of our climate metrics, which kind of set the trajectory till today. This was followed by investment in our first kind of major climate fund, so a climate multi-factor fund with LGPS Central, and that tilts away from carbon intensive companies towards that generate green revenues. We've also started improving our disclosures. So we report against the Task Force for Climate-related Financial Disclosures. This is despite it not being mandated by government, and we just see that as best practice and a good way to kind of evidence how the fund monitors and manages climate risk and how we can improve that further. This led the committee to developing the net zero climate strategy. So that was approved in March 2023. We had a total of 1,700 responses and a lot of kind of support from scheme members in targeting net zero by 2050 with an ambition for sooner, as well as our other wider metrics. This is a strategy that looks to manage both risk and opportunities by working with our managers, our underlying companies, and kind of investing in climate solutions. And this is set out in areas that relate to risk and opportunities, targets and measures, decision making, and our stewardship, engagement, and divestment approach. So if I move on to the next place, so where we are currently. So a few weeks ago, committee had our 5th climate risk management report, and we're really pleased to see that the fund and the progress towards net zero has already exceeded initial expectations. So originally in the net zero climate strategy, there's 2 primary targets which we focus on. This is in relation to reducing our weighted average carbon intensity by 50%. And we've actually reduced that by 52.8% versus our 2019 baseline, so way ahead of our 2030 target. This is a kind of metric where you can kind of consider how exposed the fund would be to climate kind of carbon price risk for in-scope investments. So it's really positive to see that that's already reduced so significantly. We've also achieved our 2nd interim target of having reduced its financed emissions by 40%, with an actual reduction of the total carbon emissions by 40.4% from that same 2019 baseline. This is the metric where you can consider the absolute tons of carbon for which the fund is responsible due to its ownership of underlying companies. And this is all despite an increase in the assets under management at the same time, which you would kind of expect emissions to increase alongside that. We've also done a lot in investing in those climate solutions and related investments that I've mentioned. So the fund now has about 20% of the total fund in these climate related investments across equity, debt, infrastructure, and forestry. And that doesn't even include the climate positive investments our other managers are doing without a specific climate mandate, just because they recognise the climate solutions are positive investments financially and in terms of wider ESG issues. So going on to that kind of 3rd point, so we can see that 75.7% of our equity financed emissions are considered to be aligning to the Paris Agreement or under an engagement programme. So this kind of this is a metric that LGPS Central undertake for us, and that kind of considers companies' risks exposure, whether they have a science-based target or whether their implied temperature rise is below 2 degrees. So this sets the fund on a positive trajectory to 2050 in supporting real-world change, but our target for 2030 is 90%. So we obviously kind of have quite a progress to make there. We're also able to monitor more of our assets than ever, and we're ahead of our net zero climate strategy in terms of those remaining assets. So areas around infrastructure and kind of private investment areas, they're harder to measure at the moment, but we were doing a lot of work with LGPS Central to kind of improve that area. And all of this progress is against the backdrop of our increasing assets under management that are continuing to outperform market benchmarks, showing the fund is continuing these positive climate actions in a way that's supportive of its fiduciary duty. This is a really positive story, but I think we're also cognizant that performance won't be linear. There's many different factors that impact our climate metrics. Up to this point, the fund has made significant investments in kind of climate equity funds, which have done a lot to reduce exposure to some of those most carbon intensive companies. And ultimately, as I said before, the fund kind of represents a slice of the global economy. So we can't avoid climate risk just by removing certain companies. It's something where we have to support real world emission reductions to achieve this. So I think just to kind of give a snapshot of our climate stewardship plan companies, this is something that's considered alongside the climate risk report every year. So I don't know if they're a little bit small on there, but they are in the public report that we have. But essentially, these are a number of companies that we focus on across material sectors. And these are companies that face a high level of climate risk and are of significance within the fund's portfolio. These are companies that are, or these are just a snapshot of certain companies that are monitored and engaged through LGPS Central, although they do a lot more than these specific companies. As you can see, this includes oil and gas companies, building material companies, and there's also a semiconductor company, which has a lot of use in computers, renewable energy, and healthcare, but is very carbon intensive in production. So if I kind of pick on Shell as an example, you can see, or I'll kind of read it out if you can't see. So their contribution to equity emissions is significant. So 4.3% of the fund's total emissions, and that's despite only being 0.4% of the total portfolio weight in asset under management. This is this kind of size of emissions is despite the fact that they have actually reduced their emissions within our portfolio by 22%. And we're kind of doing a lot to kind of review what Central are doing in engaging with them, and kind of Central's big engagement with them at the moment is around encouraging the company to align its decarbonisation strategy with the goals of the Paris Agreement. And more recently, this included voting against Shell's updated energy transition alongside 20% of other shareholders. So we'll wait to see. Shell will have to respond to that. Central have also met the chair of Shell to gain clarity over Shell's long-term business strategy, and will continue to engage in future. So as a fund, we will continue to monitor Central and their approach to engaging with these companies. Central do have an escalation approach, so we'll be ensuring that that kind of moves on as needed. So wider than that, we engage on a whole host of environmental, social and governance issues. Voting is one way we do this. So you can see that's over 125,000 resolutions over the past year. And these are votes where we expect our managers to support long-term economic interests of its stakeholders and to ensure that boards and directors are accountable to the shareholders, which are the fund. These votes include appointment of directors, approval of executive pay, climate transition strategies, and kind of better environmental, social and governance reporting where needed. And we see this as a vital part of being responsible investors. And I will leave it there.
Thank you, Kat and Declan and Ian and Bulesh for those presentations. Now, has anybody got any questions based on the presentations or clarifications? Mr. Cartwright.
Thank you, Chair. Councillor Martin Cartwright. I sit on the Pension Committee and just observing today. Chair, very, very useful presentation. There's just one piece missing for me, and that is the Pension Committee obviously come from a varying different backgrounds and varying different ages and varying different skills that are all brought to that. And the Constitution sets out what it is, and it works very well. It's very healthy, I have to say. But what was missing from there was the extensive training programme that all members have been through just recently. Much of that has been in person and online, or a combination of the two, but just to give reassurance, those members needing to know what they need to know regarding the pension regulations, which are always obviously changing, and the hiremans that have done the training for us. It's been excellent. So I'd just like to congratulate you on that, Chair, and give reassurance to anyone that's listening that we've been through that exercise. It's extensive. In terms of McLeod, again, a massive exercise, something that all pensions have had to deal with, but nevertheless, there's no massive extra resource for that. And I'd like to congratulate officers on the speed at which they've done that. And although you see the statistics where that last small percentage has not yet been finalised, there are genuine reasons behind that, because everybody's different and every case is different. And when I'm going to mention a particular case, not an individual, but when you get down to estates where people are deceased and the estate's been wound up, that's much more harder to administer than somebody that's currently living that you can do the analysis on. So don't be disheartened by the fact that we've not got to 100%. And the other one was a question, really. I know we don't give pension advice, and you might not be able to answer my question, but I'm going to pose it anyway because it's an interesting one. So let's say, I know we don't give pension advice, but let's say a member has attained the age of, lucky enough to attain the age of 55. At the moment, they've got, before the recent changes, which is another whole load of stuff we need to deal with, before the recent changes, they had two choices. They could do nothing and leave the pot until they retired, or they could take a percentage of the pot at that tax-free. So my technical question is, now that member has a different choice because they've lucky enough to have attained the age of 55. If they were to take a portion out of the pot, therefore reducing the pot, the inheritance tax will be less at the end because there's less in the pot. That's the specific question. So anyone reaching, lucky enough, it won't affect everybody, but anybody lucky enough to reach the age of 55, should they be making that consideration, because it could actually change the outcome for them? If I'm sure you'll understand where that's going.
Thanks very much. It is technical. Effectively, I think Ian alluded to the fact that money will be caught in the inheritance tax if you if you have a death in service benefit. But I'll ask Ian to see if he can cover that.
It is complex. I think it's somewhat easier in our scheme than others in regard ours being a statutory scheme and defined benefit. So drawdown per se isn't the same in defined benefit as it is in defined contribution, whereas a member can draw down an element of their benefits. So that's slightly easier for us. But in terms of the specific point about the inheritance tax, there will be scenarios, I guess, where people will need to consider their overall estate, and this is just one element of that. But as Councillor mentions, we're not financial advisors, so we've got to be very careful here that we don't get drawn, and this is quite often the case when there's any things to do with tax changes, people will come to us assuming that we're able to give that information, which we're not. We can only give the facts. So there will be scenarios where people will probably need to speak to independent financial advisors in terms of how they access the benefits to try and reduce the risk around tax. Because this is now one element that's now additional, but the subtle difference is that the benefits is defined benefit with us and not defined contribution. So the drawdown element is simplified with us.
Thanks very much, Ian. Yeah, I think you understand that, Ms. Cartwright. So really a good question, but people need to take independent financial advice. Thanks very much. Any other queries or questions? Nick?
One for you, Ian. You talk about inheritance tax and people you having to pay the tax man and calculate it, which you'll need all the rest of it. Isn't that really quite an onerous task? And because the inheritance tax, you can't get probate until you've paid the inheritance tax. And HMRC starts charging you interest after 6 months. Is that going to make the whole procedure absolutely bureaucratic and delayed, and HMRC will then charge a penal interest rate on people?
Yeah.
I kind of half expected that question might come up, Nick, so you didn't let me down. it is going to become more complex. It's going to be harder to administer, and there is potential risk of charges applied, because you're absolutely right, Nick. The process is going to be much harder to achieve payment quickly. It's quite easy at the moment. A member fills in a death grant nomination form. We can pretty much within reason pay that. The way it's going to work is we will provide the value. That information will then go to the person managing the estate, who will take account of that within the overall. If an element of that is then over the threshold, 325,000 as a norm for the majority, but not for all. But we're not responsible for that. We just get told how much of it as a percentage is over, and then we deduct the tax and make that payment. But the point Nick makes is a fair one. It could quite easily delay us being able to make those payments within the 6 months, and that then has its knock-on effect of when the estate can be closed. So you're right, Nick, it could well delay the process. I think this is new. It was only announced at the budget in November. So I think some of the practicalities need to be worked through, to be honest, as well, Nick. So I think what I'm saying now may not be the final decision in terms of how the process will work, but that's how it's anticipated. But the simple answer is yes, it's likely to take longer, and it could potentially making delay payment, and it is administratively more complex for us.
Okay, Nick, thank you. So if there are no other questions, we'll move on to item 7, which is the Hymans Robertson valuation presentation. So I welcome Mr. Tom Hoare and Mr. Stephen Tart from Hymans Robertson to today's meeting for their presentation. So over to you both.
Thanks, Chair, and good afternoon, everyone. My name's Stephen, and I work as an actuarial associate consultant with Hymans Robertson. I work alongside my colleague Tom here on behalf of Hymans Robertson as the actuarial advisor to the Leicestershire Pension Fund. So as you can probably tell, my accent isn't from down here. I'm based up in sunny Glasgow, so if there's any translation problems with the Glaswegian accent, please let me know and I can repeat anything. So today's session is all about preparing for the 2025 formal funding valuation. We'll start with a refresher on the valuation basics, so the fundamentals. We'll then look at what has happened since the 2022 formal valuation. I'll then pass you over to Tom, who will cover some of the key funding risks that we're seeing as part of the 2025 valuation preparation and what that means for the upcoming valuation exercise. We'll then have a couple of slides on the timetable for the 2025 valuation, and then round off with some of the next steps and considerations for employers on how you can help deliver successful valuation over the next 12-18 months. So how does the fund work? The fund's primary aim is to be able to pay member benefits. So I'll kick off with a high-level run-through of how the fund does this and how the fund works from a pension funding perspective. The fund collects money, so money comes into the fund. This is typically in the form of employer and employee contributions each month. These contributions are then invested by the fund under the guidance of the fund's investment advisors and asset managers, and this is what builds the fund's assets up over time. The fund also pays pensions, and money goes out each month to existing pensioners. And as we've touched on in Ian's section, the fund's a long-term fund. They'll be continuing to pay pensions long into the future as the current cohort of active members retire and start to receive their benefits when they stop working. So importantly, and for the funding valuations, we're interested in how the fund can use both their contributions and their investments to make sure the fund's able to meet all these benefits now and in the future as they fall due. Just back one slide, Kat, if that's okay. Thanks. So how do we support the fund, and how do they get in the best position to be able to meet those future benefits? So first, on the left-hand side, we have employee contributions. Employee contributions are locked in. They're defined within the LGPS regulations, so we don't touch that. We then have investment returns. So of course, we don't know exactly what will happen in the markets, what will happen in the future. So we rely on some sophisticated modelling to set assumptions about what returns we might expect the fund to receive based on their own unique investment strategy. On the right-hand side, the benefits members are prescribed, as Declan and Ian touched on, through the defined benefit scheme. So we don't, again, touch that side. And where they actually can come in is under the employer contributions. So one of the fundamentals of the valuation exercise is to set employer contributions that meet the balance of cost and ensure that the fund have the best chance possible to meet these future payments now and in the future as they fall due. So other than because we are actuaries who love statistics and crunching numbers, you might be thinking, why do we do the valuation? As I mentioned before, the fundamental reason is to calculate employer contribution rates. These are set for the next 3 years and will come into effect on the 1st of April 2026. We also need to stay on the right side of the law. There's a regulatory requirement within the LGPS to do a valuation every 3 years. It's also a good time to check your assumptions. Valuations are a great time to analyse experience, compare this actual experience with the assumptions that we set 3 years ago. That'll be at March 22 in this case. We also take time to review the funding strategy statement. We capture any new legislation or any new funding policies that have come into play. And finally, this acts as a continual health check on the LGPS and on the fund to make sure that they're in the best position to meet those future benefits to all its members. So there's lots of information that goes into and comes out of funding valuations. And the two main ones I want to talk about today are, firstly, the funding position. So is there enough assets today to cover the benefits that have been earned so far? So on the chart on the screen, this is the dark blue block over the dark green block at the bottom. So the benefits earned to date are what we refer to as the past service position. And importantly, the funding level represents a snapshot of what that position is at the valuation date. So this metric will change daily, can change quite significantly over time, and we'll have a chart later on to show you how quickly this can change. And as you can see from the chart, this is only part of the story. The LGPS is an open scheme. Members continue to earn benefits as they work, way beyond the valuation date that we're working at. As members continue to work, they accrue future benefits, and ultimately those benefits need to be paid for. These future benefits are funded via a combination of both future contributions and future investment returns. And one key thing at the valuation is how do we place a balance, or how's the balance placed between the level, or how do we set a level of prudence to place a balance between future contributions and reliance on future investment returns within the funding strategy. So to do this, we take the membership and cash flow data for every single member in the fund. We perform calculations based on a few different financial assumptions and fund-specific demographic assumptions. We consider the interaction between the fund's funding and investment strategy. As I mentioned before, this is ultimately how the LGPS benefits are funded, through contributions and investments. We then calculate the fund's liabilities based on the current LGPS benefit structure, and these results, coupled with the fund's funding strategy statement, are used to calculate contribution rates for all the employers that participate in the fund. So once we've carried out the calculations, the three main outputs for employers as part of the 2025 valuation will be, firstly, the individual employer schedule. So this will include a detailed reconciliation of the employer's funding position, going from the previous valuation to March 25, and also detail the draft contribution rates. This will be issued alongside the fund's updated funding strategy statement around October, November time next year. And this will be open to consultation where employers can ask questions and liaise with the fund officers. The valuation is then ultimately signed off by 31 March 2026, and the fund's formal valuation report will be issued and published on the fund's website. So what's happened since 2022? So on the left-hand side here, we have the funding position, and this is at whole fund level. And then on the right-hand side, we have the average employer contribution rates being paid across the fund. So this is as at the 31 March 2022 valuation. So we can see the fund had around £5.8 billion of assets at March 22 and a liability of £5.5 billion. So as at the March 22 valuation, the fund was in a relatively healthy position, surplus of around 0.3 billion, resulting in a surplus of, a funding level of 105%. If you look at the right-hand side, we can see the average contribution rate being paid by employers was around 27.2%. This can be broken up into primary and secondary rates. So the primary rate is ultimately the cost of future accrual, so the cost of future benefits. So the light green block from a few slides ago, that was around the 23.1% back at 2022 to fund that future accrual. The secondary rate is the one that takes into account the past service position or the funding level, and this on average was around 4.1% as calculated at the previous valuation. So how has this position changed from 2022? So here we have a funding progression chart between 31 March 2022 and the most recent quarter end at 30th of September 2024. So the chart on the left illustrates the change in position over time. This is again at whole fund level. And we can see initially from the blue squiggly line on the chart that the whole fund funding position has improved since 2022. And as at 30th of September 2024, the funding level was sitting around 150%. So a really healthy funding position. Underneath the bonnet, what's driven the change? So the green line is the fund's assets, and we can see there's been steady growth over the kind of first year, 18 months out from the valuation, and then in the last year we've seen quite good, quite significant returns on the fund investments, as Bhulesh already touched on. The pink line is the fund's liabilities, and we can see there's more going on with that line. It's almost a flip, or you could almost draw a line of symmetry with the blue and the pink line. The liabilities have reduced massively, with the biggest drop around about September 22, in line with the mini budget. And it's slightly bounced back from that point, generally tracked along broadly flat, or just with a slight increase up to September 2024. So the key driver in the improved funding position is largely due to the reduction on the liability side, coupled with the recent asset performance over the last 12 months. So the important thing here is the fund still holds roughly the same amount of assets in the bank per pound of pension that they have to pay. So yes, the funding position has improved, but that is generally down to the reduction in liabilities. This has resulted from rises in interest rates, high inflation environment, and also higher expected future returns on the fund's assets. So as part of the valuation, employers will see a variation of this output. This will outline the changes in their position over the past 3 years between 2022 and 2025. And I'll now pass you over to Tom, who will take you through some of the key funding risks that we're seeing at the 2025 valuation.
Thanks, Stephen. Good afternoon, everyone. I'll move through the slides. We've got a lot of content here. Appreciate some of the people in the room might have seen this before. There's a lot of detail here. Welcome any questions at the end on anything that I don't pick up on. But in the interest of time, I won't labour too many of the points. So just the first graph, and I appreciate some of the charts are quite difficult to see today. What we've got on the left, again, just to speak to the graph, first of all, is along the bottom, we're looking at March 2022, which, as Stephen touched on, that was the date of the last formal valuation. And then on the vertical axis, that is September 2024. So that's our current date. The dots represent each of the major asset classes that this pension fund and indeed most LGPS pension funds are invested in. It doesn't really matter what asset class you look at. The main thing to draw from this is that they're all significantly above that black line. And what does that tell us? That tells us that for each asset class, the expectation or the expected return from any given asset class is significantly higher than what it was 2 years ago. Now, Stephen touched on, it's not a direct correlation, but it's very, very heavily linked to what's going on in the economy and precisely rising interest rates. Okay, so if interest rates have risen, cash in the bank, you know, money that you get, the return you'll get for cash in the bank or other sort of equivalent risk-free asset like a government bond is significantly higher than what it was 2 years ago. A government bond might get you a yield of about 4% now, 4 and a bit percent. Then it follows that if you're taking a bit of a risk on equities or something like that, then you will also get a much higher rate of return. So why are we talking about this? Well, that's really important when we are talking about liabilities. Okay, now liabilities is obviously quite a technical term that us actuaries talk about, but what that means is really just the price that we put on all the pensions that have to be paid out now, but for the next 100 years. Okay, and when you're talking about things 100 years into the future, how much investment return you get is absolutely critical to all the calculations that we do. Now, clearly, if you can get more investment return on the money that you hold, then the amount of money that you need to hold today is a little bit less to actually pay for all those pensions in the future. So that's been the big story. We expect higher returns going out into the future, and that has brought down the liabilities significantly. And that's what is giving us this higher funding level that Stephen's touched upon. So just moving on then, Kat, please. The other big story that's happened over the past couple of years, which I'm sure is not lost on anyone, is around inflation. So when we talk about inflation, there's two things that are important. Yes, what's happened in the past 2 years is important, and that story is the blip, the spike that we can see in the chart here. As I'm sure you'll all be aware, inflation was really high over these past couple of years. How that then actually manifests into the pension fund is these two pension increases that are noted on the chart. So 10.1% and 6.7%. So if you're a pensioner in the fund, that's good news for you. Your pension has gone up by about 17% over the past couple of years. From the pension fund's point of view, you might argue that's bad news. That pushes the liabilities up. Okay, so that's what's actually happened. That's now passed. That's there. That's now baked into the liabilities. Of course, when we're talking about pension, when we're talking about putting this value on liabilities, we're also interested in what's going to happen over the next 20, 30, 40, 100 years. Okay, and then for that kind of prediction, as actuaries, we tend to steer back towards government policy specifically. So Bank of England targets 2%, etc. Now that's not really changed. So from an inflation point of view, those two big increases are in there. The big uncertainty maybe is around future inflation, which we'll maybe talk about. So yes, you might argue on one hand, your best bet is to just say, okay, longer term, it might be in line with Bank of England target. But there is probably more uncertainty about inflation now than what there would have been a couple of years ago or sort of 5 years ago or so, specifically even what's happening across the pond in America. Okay, some of the policies coming out there after the election, they're all perceived to be inflationary. Okay, even back at home, looking, it doesn't matter what political persuasion you are, a lot of commentary out there that might say that there's certain things that are inflationary, but equally there might be people that take an opposite view. So it's fair to say that there is a little bit of uncertainty out there. So moving on, another big uncertainty for the pension fund to manage is around life expectancy. What we've got on the chart here, appreciate some people in the room might have seen this before, it's quite interesting stuff. This comes from the market leading experts, Club Vita, that provide us and a pension fund with excellent analytics around longevity. And what we're looking at here is a map of Leicester. Leicester's pretty much bang in the middle of that chart that we can see there, and the blue indicates areas of low life expectancy or lower life expectancy, and the green areas represent areas of slightly higher life expectancy. And what this does is this is showing some of the sophisticated models that the longevity guys at the office use around postcode and lifestyling. Okay, which is one indicator of longevity. Other things are around the amount of pension that you have. So a metric around affluence. Of course, gender also feeds into this kind of thing. So not really to appreciate. You might be looking at this and worried if you're in a blue area or that you're happy if you're living in the green area. It's all good stuff. Rest assured, Glasgow is much, much worse than this. It's, it's really deep blue. It looks like there's a massive lock in the middle of Glasgow, but it's not. So me and Stephen have got about 5 years to live, according to Club Vita, so that's why we're happy to be down here today. Point about this is, even though this analytics is great. It's the best out there. It's still an uncertainty to manage. Okay, it's really difficult to predict how long people are going to live. If people live longer, pensions cost more. So moving on then, just some other interesting things on longevity. Longevity trends over the past couple of decades, they have been trending up, probably quite widely reported even in the mass media around longevity improvements. So when we talk about longevity, we're interested in what's happening today. Okay, that's maybe a little bit easier to analyse. You look at pensioner deaths and other interesting stuff that's happening as we speak. Again, we're talking about pensions need to be paid 20, 30, 40, 50 years out into the future. It's really important for us to get a handle on what the trends are going forward. And in the past, people have been living longer, and it's always been a common trend. You can see that the graph, quite steep trajectory. It has then plateaued, but still continuing to see life expectancy improvements over the past decade. The big uncertainty, and again, one of these sort of reasons for caution as we head into the upcoming valuation, we're coming out of this post-pandemic period, and you can see that the 3 dots over the past 3 years have been significantly below. If you were to just take the pandemic experience and project that forward, you would suggest that there's lower life expectancy in the future. But of course, we all know the expectation is that that's a little bit of a blip. And the difficulty that we now have is to say, okay, well, how do we, we had this pretty steady, discernible trend. How do we now take the past few years and look to project that out into the future? Rest assured, the guys back at the office and with Club Vita are the best in the business to look at this, but it is another area of uncertainty. One of the things, I've got this picture of the buck. It's maybe a bit of an odd picture there, talking about LGPS bucking the trend. Okay, what that says, quite often in the media when you get information about life expectancy or life expectancy improvements, the headline is life expectancy is slowing down, or it's quite often misreported as life expectancy is decreasing. People are going to live not as long. Okay, that's misrepresentation. Another misrepresentation is if you just pick up sort of ONS or other data on the general population. That is a misrepresentation when we talk about the pension fund. Okay, typically people in the pension fund or who have a pension, and also specifically in the LGPS, they tend to buck the trend, and they buck the trend on the upside. From a pensioner's point of view, having a pension provides a little bit of protection, and generally these people tend to live longer. Okay, but all that's baked into the assumptions that we do. We've got it captured. It's just an interesting thing to be aware of. So moving on, another one of the big risks out there, real hot topic. Kat gave a really excellent presentation about what the pension fund are doing around climate risk. Okay, and another one of the things that's quite widely reported or has been reported in the past couple of years is around pension funds, not just the LGPS, but a lot of pension funds maybe falling asleep at the wheel with regards to pension risk, our climate risk. And also us as actuaries, when we do our reports on this and how it might impact funding levels, quite often it gets reported as a fairly uninteresting result. It says, okay, the pension fund is resilient to climate risks, and it gets picked up. And quite rightly, people out there, they say, people aren't paying enough attention to this. It's not that we're not paying attention to it. What it is when we set credible funding plans, quite often we're pitching them with a level of prudence, but we're still pitching them in the kind of higher end of the mid zone. Okay, and when you're talking about climate risk or some of these other slightly more extreme risks, they live in the margins. Okay, they live at the far end. So it's not that it's not in there. It's just not. You can't set your funding strategy based on the worst case scenario. Okay, but what we're now doing and what's on the screen is to be alive to these risks and actually improve the reporting around the risks. And what's on the screen here is the increased sophistication of some of the modelling that we're doing and other actuaries are doing, other people out there in the market, and it looks at extreme events, and also it looks at more narrative-based outcomes. And it says in this particular example, what the guys have taken is a global food shock and realising that some of these things, some of the markets are very heavily correlated, and things can cascade quite quickly through supply chains, for example. Now, there's other examples out there. A food shock is just one example of how climate risk can manifest and then materialise, and then what the impact might be for a pension fund. And what we've got on the screen, it doesn't really matter. This is just a sample fund, but it shows that in certain projections in the future, there could be a climate catastrophe if you don't respond in the right way and policies aren't set in the right way, things aren't transitioned in the right way. It could be a disaster for the pension fund. Equally, there's other scenarios where it might take time to recover. Technology or policymakers and sort of work together and it improves in the future. But the point of this is just to say that there will be improved information coming to the pension fund and other people looking at the pension fund to show that we are alive to this as a risk. We're aware that climate risk is a big risk for the pension fund. It's very difficult to actually build that into the funding strategy, but where you might build it in is just make an allowance for it and say, okay, we're going to keep a little bit back in reserve, or we're going to be a little bit more prudent because this is a very difficult uncertainty to put a price on, essentially. So moving on, I'm not going to talk to this slide in detail. It really just summarises what we've talked about. So look, we're in a good position. We're not getting away from that. We're not here to be all doom and gloom actuaries. Stephen talked about the funding level. It is good news. Okay, we're 150% funded. Clearly, that is good news for the pension fund. But that 150% is predicated on a bunch of assumptions that myself and Stephen make. And their assumptions, they are our best guesses, allowing for prudence, etc., but they are our best guesses of the future. However, we don't have a crystal ball, okay, and there is a lot of risks and a lot of uncertainties out there, as we've touched on. And yes, it's good news at funding level, but the fund needs to deal with this appropriately and cautiously and steady with the idea of the long term, and not reacting too heavily one way or the other to sort of swings in markets. So the market risk that we've talked about, another risk that we've not really talked about today is just the cash flow risk. It's not necessarily a risk for employers to concern themselves with, but it is a risk for the pension fund to concern themselves with. They need to have enough money to pay pensions. Okay, so there's liquidity concerns and things that Bullish and the guys on the investment side will get involved in. Talked about longevity risk, climate risk, covenant risk as well as just employer risk. There's loads of employers in the pension fund, about 200 plus. We need to just make sure that we're alive to certain things that are going on with specific sectors and with specific organisations. So a lot for the officers to contend with, a lot for the pension fund to contend with. Again, just moving on. Appreciate there's lots of detail in the slide. Hopefully, just as we're going through this, we're covering it, and welcome questions as we get to the end. So just lastly, picture that Stephen discussed before. I'm not going to repeat what Stephen said, but just picking up the bits on the right-hand side. General insights about this picture is that the funding level is only about past service. Okay, if we're 150% funded, that is only for the benefits that have been earned to date. We still need to pay for all the benefits that are going to be paid in the future. And actually, the majority of benefits are yet to be earned, which is a key point here. And then going back to that point that Stephen made, it is a balance about future contributions. We know that a lot of employers are under pressure. Okay, we know a lot of councils have got budget deficits forecast now and for the next foreseeable future. We know that other sectors are experiencing a lot of pressure, like the university sector. Okay, we are alive to these concerns, and the pension fund want to make sure they do strike a reasonable balance about protecting member benefits, but also looking after affordability for employers. So then just some considerations as we're heading into the valuation. Again, I'm not going to touch on a lot of these. Just maybe working down the different colours. There is reasons for caution, which I've talked about today. There might be commentators out there that say that central banks are sort of signalling maybe a little bit of a slowdown for the economy, stuff around inflation, other risks. There is, equally, you could have reasons for optimism. Okay, that there is these higher rates of interest and potentially higher expected returns. It's worth pointing out that that is expected higher investment returns. They're not guaranteed. Okay, there is still investment risk when it comes to that. Investment experience recently has been quite positive, so that's maybe a reason for optimism. And as Ian touched upon, the guys have been doing great work on the McLeod remedy. There's a little bit more certainty about what that looks like. That was a big uncertainty in the past. Maybe some reason for optimism. And then lastly, just there's some unknowns out there. They are known unknowns, but they also introduce a little bit of risk. So all of this stuff we've heard about today, and appreciate the members of the pension committee in the room have heard a lot about pension review and the consultation that's out there just now. Okay, that introduces a bit of an uncertainty. There's other stuff around government attention on the LGPS, so specifically the GAD Section 13 report, and a focus on intergenerational fairness. Okay, some other stuff as well about employers and potential exits from the fund. So just lastly, going to come on some bits and pieces around maybe what to expect from the valuation. So we are in surplus. It is just a past service surplus, but we are in this strong position. 150% funded. So what are the options for the pension fund? You could probably break it down to these 4 options on the screen. You could reduce employer contributions. Okay, that's absolutely an option that's on the table, and we welcome that option. We will absolutely look to give back where we can give back to some employers, but any contribution reductions are likely to be gradual. Okay, in the same sense that when contributions go up, we look for those to go up gradually to provide stability for employers. We might look at the investment strategy and make sure that that is appropriate given the level of risk, although investment decisions are again long term, so we don't expect to react too heavily to the recent emergence of a surplus, and Bullish has talked well about the position that the pension fund's in and all the good stuff that it's doing there. So then the last couple of things there is we say, okay, we're in this good position. Are we going to look at things around prudence, things around target funding levels? So when I talked about climate risk, that's a good example of maybe reserving a little bit in anticipation for some of the uncertainty out there and making sure that employers don't bear the brunt of market volatility if there was volatility in the future. So we're looking at all these things and we're discussing with officers what to do with those at the valuation. And a little bit on a timeline. This isn't, again, not to go into detail. I appreciate you can't read this anyway. It's really just to let you know that there's loads going on. We've already been in discussions with the officers in the room today, also with the pension fund, pension committee, sorry, and we're working through this now. You can imagine if every one of these blobs on that timeline was focused at one particular point in the next 12 months, it'd be too much work to contend with. So we're moving through it at a steady speed. For the employer cohort in the room today, the key thing is, again, you can't see it here, but around sort of October, November time, we expect to get results, okay, for the employers and give an indication of what contribution rates look like. There will be engagement along the way before then, so do look out for that. And then the last thing, the flag at the end there, that's the date Stephen touched on, which is the 31st of March, 2026. So very finally, how can you help any employers in the room today? How can you help? So things around data. Clearly, the process that we're doing here is collecting data, processing data, putting a value on pensions, trying to make sure there's enough money to pay pensions. We are only as good as the data that we get. We're only as good as the data that Ian and his team gets. It's worth saying that the data quality in this fund is particularly good. Okay, so that's a credit to the employers in the room, and in the pension fund, it is an even bigger credit to Ian and his team and the officers in the room today. We advise a number of pension funds, so I'm not just saying that the data quality is excellent, but we need it to remain excellent, and that removes some of the risk that comes with bad data that some pension funds see. The next one, just stay informed. Okay, so people that are here today, people that are watching online, great, continue to look out for ways to engage with the fund, and that's the last bit there. We will be given results around sort of October, November time, but there will be engagement getting drip fed to employers and opportunities to engage with the officers today and with ourselves as well. We'll be around after today as well if there's any questions, etc. So please do engage with the process. It's valuable for everybody. And I think that is everything that we were looking to say today, and I do welcome as many questions as anyone's got.
Thanks very much, Tom and Stephen. It's a very involved presentation. Has anybody got any simple questions? Nick?
To what extent, you talk about pensions being a very long-term projection, quite rightly so. To what extent have you taken into account the huge changes in demographics that are basically now baked in when you have a total fertility rate of 1.0 in China and throughout the rest of the world, apart from parts of Africa, the world's population is going to actually fall in this current century. You have a situation like Bulgaria, where their population in the last 30 years has fallen from 9 million to 6.5 million, and in terms of returns going down, how much has that been taken into account in your valuation estimates?
Yeah, thank you. So it's a good question, and again, it speaks to there's a lot of stuff out there in the media as well, and it's all absolutely relevant for the pension fund. Where it becomes relevant for the pension fund, when we talk about demographics, the things we focus on are when are people going to take the pension and for how long. Okay, and who's taking their pension. So clearly the people in the pension fund are our primary concern when we're looking at valuing liabilities. So some of the stuff that you touched on there about longevity, okay, is very important. Some of the stuff that we talked about today on longevity, and we use analytics for that. The other thing that you talked about is probably more speaks to future predictions, okay, about who's going to be in the pension fund. So if you're talking about birth rates slowing down or population slowing down or speeding up, whatever side of the coin you're on, they're not yet in the pension fund. It absolutely is something to be aware of. So for example, and this Ian showed a graph earlier about the membership in the pension fund. We still are largely immature is the word that we say, and that means we've got a lot of active members compared to deferred members and pensioners. Now, if there was a scenario in the future where the number of active members started decreasing, okay, now that could be because of demographics. It could also just be because of changes within local government. And there might be, I know there's talk out there of certain councils. For a long time, actually, this talk's been out there. It's not actually materialised, but of restructuring, okay, or certain people moving out of the LGPS for a variety of reasons and dwindling active numbers. Now, that's something that we would absolutely need to factor into our calculations, but we don't need to factor it into our calculations yet because they're not yet in or out of the pension scheme. But as a longer term thing, it is very important for the officers in the room today to manage. So if a pension fund becomes immature, that point I made earlier about cash flows becomes very, very relevant because you don't have money coming into the pension fund. And in fact, you're actually paying out a lot more money than you're bringing in, which means you're using your assets to actually pay out those pensions rather than the cash coming in. So it is all very relevant, but it is not yet relevant for the the funding levels and the contribution rates that we're talking about today.
Okay, thanks very much, Nick.
Yeah. Just to sort of understand in terms of the pension fund itself, the demographics, but I'm just thinking about the future returns from equities going forward, is that if the world's population falls by 2 billion, are we going to get those kind of returns that were projected?
Yeah, I'll maybe just again, it's a great point that speaks to the investment risk that we're talking about. And I know people weren't in the room today, and I know you also had a question. We gave a similar presentation to Pensions Committee, and I think you raised a similar question around some of the projected returns. Okay, and absolutely would lean into that question in the sense that we do have a model. Okay, we don't have a crystal ball, and it is right to be cautious about the level of investment return that you're going to get in the future. So we have numbers that are predicated on a certain amount of return. Those are predictions, those are not certainties. Okay, and this is exactly why the pension fund needs to proceed cautiously.
Thank you. Thanks for the question, Nick. Anthony. Yeah.
One of the, excuse me, in one of the earlier slides, first speaker, right in the middle of it was models. And I'm curious to know how your company makes sure your models are as good as they can be. How much is invested in just making sure that those models that you put all the data through are actually going to be as real as they need to be?
Yeah, thanks for your question. The results are only as good as the models, so it's definitely a primary focus. Certainly at Hymans and across all actuarial advisors, that they invest heavily in developing models, making sure research is at the forefront of any model that is used to kind of underpin these kind of results. I don't know if Tom wants to add anything further, but just in response to your question of the relevance of it, it's one of the top priorities because, as I said, the results are only as good as the models themselves.
Okay, thank you.
Yeah, thanks, Stephen.
Yeah.
I'll maybe just add to that. You can come in.
Well, it was touched on a bit when you were talking about climate change, but so I'd be curious over the last year, how much has the models changed as a result of things that you're noticing going on in the wider world?
Yeah, it is an excellent question, and we're very aware that we come here and we talk about numbers and figures and everything like this, but it's all predicated on these models that we have behind the scenes. So the main model, and just to reiterate the point Stephen made, before it even gets to the model, okay, we have the data, And that is a really key point, and we heard a lot today about the data. So just to reiterate that point, the data is good, but it needs to remain good, and the guys in the room work very hard on that. When it comes to us and we get that data, we need to put it through our models. The models that we use are not, they are our own model, but that there's a certain amount of detachment from them. People can also prescribe. The particular model that we use for all of our investment modelling is called the economic scenario service. Okay, people can actually prescribe to that model. It is an in-house model, but it is not just a couple of guys with a spreadsheet. For example, we actually get regular sort of training as actuaries with the modelling team to understand the governance process around that model. It is very, very robust and very rigorous, I can say. So what feeds into the model is a lot of mathematics, okay, a lot of very technical detail, a lot of academic research. I think there's about sort of 12 to 15 qualified actuaries and other people of that sort of caliber that work and provide challenge and constant review of the model. The model itself undergoes what we call a minor calibration every month, okay, to reset to the market conditions. It also undergoes a major calibration at intervals, largely about every year, but it can react to different things that are going on, so it can be slightly longer, slightly shorter than that. And it looks like, and that also is a model used for climate risk as well, and it reacts to new information emerging. Yes, the model does change over time. Like, we recognise that, you expect it to change over time, but there's a lot of rigour that sits behind it.
Thanks very much. That's reassuring. So if we have no other questions, we'll move on to item 8, which is the Local Pension Board Annual Report. A report compiled by the Local Pension Board has been included in the agenda pack at pages 121 to 132. And an update from the board's chairman, Mrs. Rosita Page, has also been circulated and published online. Mrs. Page has given her apologies, but the report gives a comprehensive update of what the board has been up to, and I would recommend scheme members to have a read. It was particularly pleasing to see that the board has no concerns over the fund or its administration, and their oversight of such issues as McLeod and risk management and assurance continues. We will take the report as noted. So on to item 9. A report of the Local Pension Committee employees representatives on the agenda at pages 133 to 134. And I've been informed that the report will be taken as read. Does any staff represented on the Local Pension Committee wish to add anything further than what is in the report? No? Okay. So on to item 10. Appointment of the scheme member employee representatives to the Local Pension Committee. So we come to the voting for a scheme member employee representative for the Local Pension Committee. The vote is open to all those who present who are members of the Leicestershire County Council Pension Fund, that is, active contributors, deferred members and pensioners. Voting slips have been passed around and circulated. If there's anyone who hasn't got one, but they think they're entitled to vote, please raise your hand. So we've done a job on that. We've got those out. We have one employee representative post available, which is for a period of 3 years. We will also seek a reserve representative. The post is for a period of 1 year, and should a vacancy occur over the year, the reserve employee rep will be asked to take the place of the vacated position until the next AGM. As we have 3 nominees, a ballot will be taken. You are asked to vote for the person you want to take up the main 3-year employee representative position. The person receiving the greatest number of votes will be elected to that post. It is intended that the person who receives the second highest number of votes will be offered the position of reserve employee representative for a period of 1 year. Does anybody have any questions? No? Right, so if you can complete the nominations before you on the form of Vipul Bakar, Ray Hurst and Rupert Sims. You will each have in front of you a statement from each nominee and a voting slip. Please could you now vote for the person you wish to appoint to the 3-year position and place your slips in the box, which will come round. Save you coming to the front. We'll come and collect them from you in the box. So has everybody voted and handed in their slip? Okay, everybody's handed in their slip now is entitled to vote. Great. Just give us a moment, we'll get the result. Okay, so the employee representative for 3 years is going to be Vipul Bakar, who got 10 votes. The reserve for 1 year, strangely, the vote was tied between Ray and Rupert, so we will be having a conversation with them later on, and we'll come to a decision on that later. Okay, but Vipul is the employee representative for 3 years. Thanks for your voting. So, item 11, appointment of a scheme member employee representative to the local pension board. We have received one nomination for the position of scheme member employee representative on the local pension board, and that's Manjit Saroya. This position will be held again for a period of 3 years. Mr. Saroya is duly appointed. We have received one nomination for the position of scheme member reserve employee represented on the local pension board, and that's Andrew Stewart. So Andrew, the position will be held for 1 year by him, and Mr. Stewart is duly appointed. The date of the next pension fund annual general meeting 2025. I move that the date of the next pension fund annual meeting will be held on the 15th of December 2025, and this date will be published on the fund's website. So everybody happy with that? Yep, good. So that means there are no urgent items. Officers will be available after the meeting for a short time if you have any questions. I'd just like to thank you all for attending this morning, and I now declare the meeting formally closed.